We're going to get into that in the Iron Condors in a second. Now, here's a special note on time decay. Time decay, or theta erosion, is actually two things. It's time value that we spoke of in the price of the option. That's a small portion of it. But as you get closer and closer to the expiration date of an option, there's less time for the volatility in the market to move the price, which means that there's less risk. That translates into what we see as time decay. You know, less time for prices to move, lower risk overall, or lower exposure to risk overall, and the prices start to come down. In the last 30 days of an option's life, and you can see by the chart in front of you, the implied volatility, actually the entire price of the option goes down very, very rapidly. And that's one of the things that we're playing on using Iron Condors. We want to take advantage of that massive drop in the very, very end of the period of the options life cycle. So that's another thing that we need to keep in mind. We're going to be doing Iron Condors ideally for a relatively short period of time. I've seen, from my experience, the kind of sweet spot for doing Iron Condors is anywhere between 20 to 40 days away from the expiration date. You can do even shorter ones. You can do weeklies and things like that, but you have to have very, very high volume options. You have to have options that have very tight spreads, lots of opportunities for trading. But for the most part, the majority of the Iron Condors are between 20 and 30 days to expiration, 20 and 40 days to expiration. Now, let's get into it. We came here to talk about the Iron Condors as a strategy itself. So why do we trade Iron Condors? What's the reason for getting into an Iron Condor trade? Number one, we expect a stock price to stay within a specific range. We think that we can take advantage of a relatively range-bound stock, and depending on how we set up the trade, it can be a very wide range. We're looking to take advantage of a high implied volatility and premium to capture profits. We like the fact that Iron Condors give us specific risks, specific limits to our risks, and we're taking advantage of an option's natural tendency to be overpriced. Now, why do I say that options have a natural tendency to be overpriced? Because the pricing of options are typically driven by the sellers, the people who are writing the options. And when they write the options, not only do they want to take advantage of or take into account risk, they also want to get a profit. So they build in the risk premium, the implied volatility, and part of that, they're actually pumping it up and going higher because they want to make some money out of the market. And we can ride on that particular tendency. We can actually use that to our advantage. The last piece is Iron Condors, if they're set up correctly, are high probability and consistent trades. Now, we've got John Kelly, who is doing a massive amount of Iron Condors. He refers to them as credit spreads because he actually gets into the different parts of them separately. But effectively, when he's done, he's got an Iron Condor. I've seen him with 100 of these trades on, and they're high probability. The majority of them are going to win. The majority of them are going to be in our favor, and they're very consistent. You can make money time and time again using this trading strategy. Now, there are absolutely risks. There's no, there's no trade that doesn't incorporate some level of risk. But Iron Condors are ones that you can actually play very, very high probabilities on these trades and overall manage the risks well. Okay. Here's the basic trade for creating an Iron Condor. We have a stock that we've chosen. We're going to sell a call option at a strike that's currently above the price of the stock, of the current price of the stock. So we're picking a strike of the call option that is above or out of the money from the underlying stock price. Now, having a short call position is very, very risky. Now, some people trade this. There's a lot of people who do. It can be a very good position in and of itself. But I'm not one that likes to take excessive risks in that particular type of a strategy. Just exposing yourself to a naked call. If the market goes up radically, you can lose a lot of money. You can lose more money than even is in your account. So you don't want to do that. So what we do is the next step is to put a protective call option. That's to buy a call option at a slightly higher price. So we've got, in the case of, say, a $35 stock, we might have a $45 short call and then a $50 long call that's protecting us on that side. Now, to create the Iron Condor, we do the exact same thing on the opposite side. We short a put option, which is below the current price of the stock. The strike for the put option is below the current price of the stock. And then we buy another put option below that to protect ourselves in case of a radical price movement. Overall, it creates a profile that at expiration looks like what you see right here. In this particular case, let's assume that the stock was $45. Our short put was going to be a $40 strike short put. The short call is a $50 short call, and we protect ourselves with a $35 long put and a $55 strike short long call. So those are all the elements of this trade. Now, anytime you're trading, you have to decide on the target. You have to know what trade you're going after, and that's a pretty important thing. Choosing the trade tells you whether, allows you to pick a trade with an edge in your favor or not. Now, as a really quick test to see if a stock is a good opportunity for an Iron Condor, there's a couple of things that I like to see. And I set up my charts to kind of show this to me. Number one, I like to see that the implied volatility is high relative to the normal price movement of that particular stock. And in this chart, you can see that the blue line here is the implied volatility. That's just the implied volatility across the entire series, kind of an average. The yellow line down here is a measurement of historical volatility. That's using a formula called a log normal standard deviation. All it's doing is it's looking at the change in prices on a daily basis. The close of the price today compared to the close of the price yesterday. It is doing it in what's called a log normal fashion to take into account the fact that a 1% drop down dollar-wise is actually less than a 1% gain up. So I know that sounds a little strange, but it is true. Going from 100% to 99% is actually a smaller price movement than going from 100 to 101. Now, or 100 to 101%. So that's the first test. I like to see this. A couple of characteristics of a stock that I really like for Iron Condors is the implied volatility consistently runs higher than the historical volatility. Now, this is actually a symbol that one of the people that I work with showed me the other day, and I really like this as an opportunity for a trade. Now, may not work out great, but we'll see. Dollar Tree, which is the symbol that we're looking at, has an implied volatility that is consistently higher than the historical volatility. There's very few situations where the implied or the historical volatility measured is actually lower, is actually higher than the implied volatility. We get one little stretch in here, we get a kind of stretch in here, but for the most part, implied volatility is always high on Dollar Tree, which means there's always general worry and things like that about Dollar Tree, but for the most part, it never actually translates into massive stock price movement. That's a good indication that this could be a good Iron Condor. Second thing that we have to do is a little bit of research. Once we find a stock that does have these characteristics, high implied volatility relative to its historical volatility, the thing you want to do then is do a little research. Make sure there's no risky events coming up. By that, I mean between now and the date that your Iron Condor expires, between the point where you're going to probably be out of this trade, is there anything coming up in the market that would drive the price radically in one direction or another? Is there an FDA announcement? Is there an earnings announcement? Is there some kind of major contract that's coming up? You can even step out a little bit and say, is there any other competitors that are doing something, really amazing that they're going to be launching as a competitive product? I mean, literally, you want to be, looking to see if there's anything that's scheduled to be announced or released that's going to radically drive the price of the stock. If you have an event like that, you stay away from it as an Iron Condor. Now, the third thing is, and this is one of my sniff tests. There are things a sniff test. By a sniff test, I mean I want to, scratch at something until I can figure out whether it smells good, smells right, or doesn't smell right. If the implied volatility is so radically high compared to the actual normal price movement that you're saying, wow, this is an amazing trade, it probably is too good to be true. You have to be careful with that. Be very, very careful of trades that are too good to be true. What you want to do in those situations is figure out why it's too good to be true. Now, this might be a great trade. There may be something driving the price of the options that we don't know about. But it's worth your while to sit there and say, okay, why would this option be charged cost so much for this trade? Is there something that's going to affect it? Is there an accounting error or an accounting fraud that might drive the price of this stock all the way to zero? Is there something crazy that might come out of the woodwork sometime soon? Usually with a little bit of research on Google, you can find it. It's out there. Nothing like this happens in a vacuum. There's a source of information. You just got to put some effort into finding it. And really stay away from the ones that are just too good to be true. Now,